So venture capital is investment in private companies that have found an exemption from registration, and particularly in high growth companies, traditionally technology companies. Venture capital investors invest other people's money in these startups or potentially more mature companies, and they do so through one or multiple exemptions from registration. The companies they invest in are not publicly traded in the stock market. You cannot buy them. And their goal, or at least traditionally their goal, was to buy companies that would eventually go public and they would cash out at the IPO. That model has changed a bit as IPOs have slowed down, but they would buy the stock in 10 years prior to the IPO, maybe at $1 a share or 50 cents a share, and hope they would go public at $40 a share or $100 a share and make huge returns, as well as holding on to some of that stock and hopefully it get traded. And so, just actually staying on Andreessen Horowitz, I actually, you probably will recognize. So see if you know any of these investments that they made. So more recent ones you might not know as well, but Coinbase, right? Coinbase is the company used, it's the wallet for trading cryptocurrency, #1 company for cryptocurrency trading. Oculus VR, that sold to Facebook for, I think it was $7 billion. So that was a nice transaction. GitHub, some of you may have used GitHub. Y Combinator has its own fund. A couple names in 2000, a little more famous, early investor in Facebook, early investor in Groupon, Twitter, Zynga, Airbnb. This is like the who's who, right? I mean, this is the kind of the big ticket items. So they invested in these companies before they went public and hoped to make money at that IPO or potentially in a merger or acquisition event. So what are these exemptions? Well, we begin with Reg D Rule 504, the friends and family funding. We'll also talk about, most of this is under a regulation called Regulation D. I'll go through this in a minute. Reg D Rule 506B, 506C. There's an exemption under 147, exemption called Regulation Crowdfunding. Regulation A+ is new. So there's a number of different regulations that I will present to you today. Of these, 506B historically has been by far the largest exemption, where since 1982 or so, when it was promulgated, trillions of dollars have been sold through this exemption. The other ones have been more minor. Some of them are new, though. 506C was promulgated in 2013. Crowdfunding came online in 2016. Reg A+, I think, came in sometime in between. And we'll cover all those in some detail. So the concept is that although I just told you that under Section 5, all stock must be registered before it is sold, there is a caveat, unless it's exempt from registration. So the game to play is called Find the Exemption. Because as I just mentioned, going public requires finding an underwriter, spending $4 or $5 million a year potentially on public filings, complying with various listing requirements, reporting your financials quarterly. Oh, you know what, I hadn't mentioned it. So quarterly, annual, special. I did mention the annual filings are 10K. The quarterly filings are called 10Q for quarterly, and the special filings are 8Ks. And so every time there is a material event, like a merger of a significant company or an issuance of a debt security or something like that, an 8K is triggered, and it basically it's like a catch-up thing. So within a couple days of a major event, the company has to file those special reports as well. 10K annual, 10Q quarterly, 8K special. So you don't want to file these if you can avoid them, because it's expensive to comply with them, and so we're going to try to have our securities be exempt. So there are two exemptions within the Securities Act. The original act itself from 1933 has two exemptions built into it. One exempts the securities, the stocks, and the other exempts the transaction. So first, Section 3 exempts securities, meaning that certificate can be sold by virtue of the nature of the certificate, not how it is sold. And so it mostly is not relevant. It mostly pertains to government bonds, which is why I've included a picture of a treasury bond in this. The government does not have to register its treasury bonds because government bonds are exempt from the Securities Act. So the government does not have to register with the SEC. It kind of makes sense. And they've been a pretty good investment so far. That one was 10.125%. I don't think we're getting anything close to that now. But they've generally, they've never defaulted. So we have a couple of these exemptions. There's also, by the way, and this is really getting into the weeds and not super thrilling for you guys, but Section 3B, that's 3A, is all this sort of government, short-term commercial paper, interest-rate securities. Section 3B also has an exemption for class of securities offered to a limited public offering underneath a certain threshold amount. And that amount has been amended over time. It was 100,000 when in 1933. It's 5 million today. And the question there becomes, what is a limited offering? So that's sort of a fundamental question, which is answered by a regulation that we'll come to in a minute. I'll tie that back. So all you need to know about Section 3 is that it exempts certain types of securities, but it's really mostly about government bonds, except for one exemption I'll return to. The more important section is Section 4, which exempts transactions. So a particular issuance of stock will be permissible under Section 4. And this is the larger and more relevant exemption for most of what we call private placements, of which there are many different styles. These are transactions that have a couple requirements. The requirements vary depending on the regulation that they are issued under. They all have to be issued not through an underwriter. So that whole underwriter concept, you are not permitted to use an underwriter or a broker-dealer in the sale of these transactions. So these are direct sales, not through an underwriter, and that applies globally. And it can't be in any public offering. Now, again, in the weeds, but I'm currently doing some research to distinguish between the 3B limited public offering and the 4.2 no public offering. There's obviously some distinction in the statutory language, but in any event, it's really the regulations that matter more, because 4.2 in the Securities Act is vague. Securities Act 4.2 has a very vague standard as to what is a private placement and what will qualify as exempt under 4.2. It was promulgated in 1933 along with the Act. The language hasn't changed. In 1935, the SEC issued some guidance and provided a 4-factor test, which is also vague and pretty unreliable. But in any event, the test is, such as it is, courts will consider, and it doesn't tell you how to weight these factors. So, by the way, people did not like this. The penalties are huge, and you're not sure in advance if you're going to be able to have an exemption. Courts will consider the sophistication of potential investors. So, I don't know what that means. How smart they are, how many times they've invested. That has devolved, in my opinion, into wealth. Nowadays, we measure sophistication by wealth, and if you have $1 million, we consider you an accredited investor, and if you don't have $1 million, you're not. And so this concept of sophistication has transmogrified into being wealthy, which, trust me, it's not a great proxy. I'm sure some of you know some very sophisticated people who do not have $1 million, and you may know a few people that have more than $1 million who aren't particularly bright. So, in any event, first factor, sophistication of the purchasers, now is sometimes is measured by wealth. purchasers access to material information. So that's what is material, how much access, broad, vague. Number of offers, I illustrate 4 here, that'd probably be okay, but they don't give a number. They don't say you can make 12 offers, you can make 30 offers. You can't put an ad in a newspaper. They ruled on that later, but can you call 12 friends, 5 friends? What's the number? Don't have a number. And the manner of the offering. Again, not particularly clear what that standard means. So the bottom line about 4.2 is although it provided the baseline for an exemption, it was so vague and so unreliable, it created all these regulatory uncertainties that it did not lead to a substantial amount of private investment until the SEC promulgated a very fundamental rule under 4.2 and actually 3B that clarified these rules and provided safe harbors for certain types of placements, provided that they complied with some additional requirements. So, as I mentioned, Section 4.2 exempts registration from registration for transactions by an issuer not involved in any public offering, but it's vague. And so, in 1982, the SEC promulgated Regulation D, and it creates a series of safe harbors. There's actually 6 parts to Reg D, and they're all numbered rules. So Reg D has 6 rules, rules 501, 502, 503, 504, 505, and 506. And as I'll come to in a minute, 505 has been repealed. It's no longer, it's overlapped. So again, I'm going to come to these in the next slides. But the first 3 are effectively definitional, and then it's 504 and 506 that are the actual exemptions. So let's talk about 504. 504 is also known as the friends and family exemption. And 504, interestingly, is actually promulgated under Section 3B, and it allows offerings up to that maximum amount as 3B specifies, which now is $5 million. That was a recent amendment. Now, that exempts a security, although it does not permit resale, because that same rule says that stock issued under that exemption may not be resold unless they have a new exemption. So it doesn't get you resale, but it does allow you to sell to anyone. Grandma, grandpa, your nieces, your nephews. And this is really important because this is the first place most entrepreneurs look for capital. They look into their bank accounts, they look in their credit cards, they look to their friends and family. And it does have a couple requirements. The requirements are, and again, there's no requirement on who you sell to, but the manner, and again, more specific and clear, no general solicitation. Now, what is a general solicitation? Again, current research I'm doing, asking the question, is posting on Facebook a general solicitation? Is sending a direct message on Twitter a general solicitation? Is picking up the phone and calling all of your aunts and uncles? If you have 12 of them, 15 of them, what's the number? When do you get to general solicitation as opposed to no general solicitation? So that creates a little vagueness, but Rule 504 does have that prohibition. And you don't have to make any disclosures. So long as you're not making a general solicitation and you're only selling $5 million, you can sell stock to these folks without making any of the disclosures that we talked about. Private transaction. All right? So you can sell, and again, mostly to friends and family. Rule 506B, promulgated under 4.2, is much more powerful, however, because it allows an unlimited sale of stock, not limited to $5 million, but any amount. You could sell $1 billion, and there have been transactions approaching that amount in the private markets. But there's a catch. You can only sell to accredited investors and 35 non-accredited investors, but you have to be very careful about how you get in touch with them. Accredited investor is defined as an individual, it's over here with an angel, such as an angel. So you can sell to what are called angel investors. Angel investors are individuals who are generally not professional investors, are investing their own money, and have, in fact, I should have rewritten, this I pulled from the internet, I apologize. This under $1 million investment is not correct. That's not accurate. Actually, I had misread that when I pulled this from the internet. They have to have at least $1 million in net wealth to be accredited and to be permitted to invest. But you actually can sell an unlimited amount to them. Don't believe everything you find on the internet, even if it's about Coca-Cola. All right, so the fundamental difference between angels and venture capital, as I was talking about venture capital before, is angels are investing their own money. They're wealthy people investing their own money. Venture capital investing other people's money. And this rule, 506B, was super useful because it meant that you could sell to venture capital investors to an unlimited amount and raise huge amounts of money. And this is the exemption that allowed Twitter and Facebook and all these other companies that you know about to obtain billions of dollars from venture capitalists like Andreessen Horowitz under Exemption 506B, promulgated as a safe harbor to the unclear 5042. New is 506C, and I highlighted the picture of the angel here because 506C is the only exemption that allows an unlimited sale and general solicitation. And an entire new industry has sprung up to fulfill this, the desire for securities offered in this way. So 506C allows unlimited offering, and general solicitation is permitted. You can advertise. You can advertise in the newspaper. You can advertise certainly on Facebook. And there are entire websites dedicated to selling to these kind of investors. I'll show you one of them. So, do I want to? Yeah, I'm not going to log in right now. So you can see here, this is a website called Angel List. And Angel List allows you to, as you can see, there's a tab here, invest. You can invest in startups. They have funds. You can work with professional investors. You can get involved in particular deals. Anyone here have a Ring doorbell? I have a Ring doorbell. Ring's a private company. Do you want to buy stock in Ring? Well, too bad you can't. You don't have $1 million. But if you had $1 million, you could go to this website and invest in the Ring doorbell company. And this is really interesting because this is effectively, this is an advertisement, right? And, oh, I guess they have an exit. Sorry, you can't anymore. Amazon got them for $1 billion, so you missed your chance. So this entire industry of, well, you might even think of it as crowdfunding, but this sort of publicly available information about investment exists because of Rule 506C, which again permits an unlimited fundraising from and general solicitation, but it does have the requirement that everyone must be an accredited investor. You cannot sell to any non-accredited investors. You cannot sell to mom, dad, grandma, grandpa. And the reason I put the angel here is that this is really a useful resource for wealthy individuals that are not part of venture capital firms. The venture capital firms, as businesses, have can source these investments. They don't necessarily need to go on a website and scroll through, right? People come to them and try to, getting an appointment with the VC is the hardest part of getting startup funding. They're very busy, and you have to really try hard. You have to even get a meeting to even pitch a venture capitalist. So there's people coming to them, begging them for money all day long. Folks like this, an individual who's got $3 million in net wealth, no one knows he's around. These websites have really facilitated their ability to invest. And it's a type of crowdfunding. We'll come back to the crowdfunding exemption, but I see this as a type of crowdfunding because you can raise a large amount of money from a large number of people via the internet, which is how I define crowdfunding. So those are our Reg D exemptions. And again, they were 504, 506B, and 506C. 504B, the friends and family exemption, can only raise $5 million, and you have to be careful that it is a limited offering. Not clear exactly what a limited offering is, where those bounds are, but you can sell to mom, dad, grandma, grandpa, nieces, nephews. 506B, the traditional way to sell to venture capitalists, and not a problem for them because they've got people banging down their door all day long, and that's not a general solicitation to go to Andreessen Horowitz and knock on the door and try to get a meeting. But for angels who may not have this deal flow and don't have people banging down their door, 506C gives them access to these new investments through the internet and through this ability to advertise.